Budgeting is a crucial part of any business's financial planning process. Traditional budgeting methods rely on historical data to forecast future expenses and revenues. However, these methods often lack flexibility and fail to account for real-time business changes. Driver-based budgeting connects financial planning directly to the key factors that drive your business performance. Instead of focusing on line-item expenses, this approach identifies and focuses on the operational activities that impact financial outcomes. By linking budgets to these real business drivers, organizations can develop more accurate forecasts and create strategic plans that adapt to changing conditions. Unlike traditional line-item budgeting methods, driver-based budgeting emphasizes the cause and effect relationship between business activities and financial performance. By identifying and focusing on critical drivers, organizations can create more flexible and predictive budgets that respond to changing business conditions. A retail company may use customer foot traffic and average purchase value as key drivers for revenue forecasting. Instead of making arbitrary revenue estimates, they can build their budget based on the expected number of customers and their average spending behavior. A manufacturing company may use units produced, labor hours per unit, and raw material costs as key drivers to forecast production expenses. By adjusting these drivers, the company can dynamically update its budget based on changes in production levels. Driver-based budgeting improves forecasting accuracy by basing budgets on real business activities rather than historical data alone. This approach reduces guesswork and makes budgeting more data-driven and realistic. Since driver-based budgeting focuses on key operational drivers, budgets can be quickly adjusted when business conditions change. This flexibility allows organizations to respond proactively to market shifts, supply chain disruptions, or new opportunities. With driver-based budgeting, decision-makers gain better insights into what truly impacts financial performance. By focusing on key drivers, leaders can allocate resources more effectively and make informed strategic decisions. Traditional budgets often operate in isolation from business strategy. Driver-based budgeting ensures that financial plans align with the company's strategic goals by emphasizing the factors that drive growth and profitability. Driver-based budgeting allows businesses to run multiple what-if scenarios by adjusting key drivers. This ability helps companies anticipate potential risks and opportunities, improving overall financial resilience. Business drivers can be classified as internal drivers and external drivers. Internal drivers are factors that a company can control or influence, such as pricing strategy and production output. These are related to internal operations, business strategies, and resource allocation. Because these drivers originate within the organization, businesses have the ability to adjust them to optimize performance and improve financial outcomes. External drivers are factors outside a company's direct control, such as market demand, raw material costs, or exchange rates. These drivers are often linked to the broader economic environment, industry trends, and market conditions. While businesses cannot control these factors, they still significantly influence financial performance. Businesses must monitor and adapt to them when building their budgets. Business drivers can also be categorized into three key types: rate drivers, volume drivers, and efficiency drivers. Each type influences financial performance differently, and understanding these distinctions helps businesses create more accurate and actionable budgets. Rate drivers represent the price or cost per unit of a given activity. They define how much is earned or spent per unit of output, making them crucial for revenue forecasting and cost control. The selling price of a product or service determines revenue. Businesses adjust pricing based on demand, competition, and costs. Labor costs depend on the hourly rate paid to employees. A rise in minimum wage or salary adjustments affects total labor expenses. The cost of materials used in production impacts profitability. Fluctuations in supplier pricing or market conditions can cause cost changes. The cost of borrowing affects financing expenses. Businesses must account for interest rate changes when planning debt repayments. Volume drivers measure the quantity of activity, such as units sold, produced, or serviced. They are essential for capacity planning and revenue forecasting. The number of units sold determines total revenue when multiplied by the price per unit. The number of goods manufactured affects material and labor costs. The number of visitors to a retail store impacts potential sales. The number of online visitors influences digital revenue and advertising strategies. Efficiency drivers reflect how well resources are utilized to generate output. They measure productivity, helping businesses optimize costs and improve performance. Labor hours per unit are the hours required to produce 1 unit of output. Lowering this through automation or training improves efficiency. Conversion rate is the percentage of leads that turn into customers. A higher conversion rate increases sales without additional marketing spend. Inventory turnover ratio is the speed at which inventory is sold and replaced. Faster turnover reduces storage costs and improves cash flow. A well-structured driver-based budget incorporates all 3 types of drivers to ensure comprehensive financial planning. Successful implementation of driver-based budgeting requires a systematic approach. The foundation of driver-based budgeting is identifying the right drivers that directly impact financial performance. Examine which internal activities and external forces affect your revenue and expenses. Determine the relevant rate, volume, and efficiency drivers for your particular business. Once drivers are identified, businesses must determine how each driver affects financial outcomes. For example, sales revenue equals number of customers times average purchase value. Total labor cost equals labor hours times hourly wage. Marketing ROI equals ad spend times conversion rate. Understanding these relationships allows businesses to create more realistic and responsive budgets. A driver-based financial model is a dynamic tool that links key drivers to financial statements. This model includes revenue projections based on sales volume and pricing, cost estimations tied to operational activities, profitability analysis based on different business scenarios. With this model, organizations can forecast financial performance more accurately. Use the model to test different scenarios, such as, what happens if raw material costs increase by 10%? How does a 5% increase in customer retention impact revenue? What is the financial effect of hiring 10 additional sales representatives? Continuously track your key drivers and adjust the budget as new data becomes available. This ensures the budget remains relevant and effective throughout the year. You can connect your budgeting model to real-time data sources, such as sales data, production reports, and market trends, to ensure the projection is accurate and current. Driver-based budgeting is a powerful financial planning method that improves budgeting accuracy, flexibility, and strategic alignment. By focusing on key business drivers, companies can build more dynamic, data-driven budgets that adapt to changing market conditions. Organizations that embrace this approach can make smarter financial decisions, optimize resource allocation, and improve overall business performance. Thank you for joining us in this exploration of driver-based budgeting. Please like this video and subscribe to our channel to receive notifications about future videos.